All right, so let's start with just in general property risk management. And when we talk about property risk management, we're going to talk both in terms of personal, like just your individual ownership of property, as well as business ownership of property. But property coverage as opposed to liability coverage is what we call a first party coverage, because if there's a claim, it's your benefits. You're getting the check. Your damaged roof, you get a check for the damage to your roof, as opposed to a liability claim where you're responsible for damage to someone else. The insurance company is acting on your behalf. They become your wallet instead of you, and they're making the payment to a third party. So that's called a third party loss. So first party coverage versus third party coverage. So next chapter is all about liability, but today we're talking mostly about property coverage as a first party benefit. And when we refer to property risks, those of you who are currently in estate planning and have been there before, this should sound familiar. When we talk about physical property, there are two big broad categories: real property versus personal property. And when we say real property, just add another word to that and think of real property as just a shortened version of the term real estate or realty. Because real property is property that doesn't move. It's fixed. Land, buildings, plants and trees, and attached fixtures like fences or solar panels or windmills or whatever. And they have a different risk. They present a different risk because they don't move around, right? As opposed to personal property, which is essentially defined in the negative. It's everything that's not real estate. So your tools and cell phones, your bike, your car, your clothing, all of these things are mobile. And they represent kind of a weird risk because they can move around. And when you're an insurance company, you care about the nature of the risk, and whether it's real estate or personal property presents a different set of risks. And within those categories, of course, it's like, well, how do I value losses to either my real property or personal property? And insurance companies are willing to use, depending upon the quality of your property and the kind of coverage you're looking for, they will pay you for a claim. They'll value your claim based on either its actual cash value, in some cases also known as your fair market value, or the replacement cost of that item, whatever it is. So from the standpoint of real estate, if you have a claim for damage to your roof, this is my favorite because everybody, like I said, just kind of hopes that they get hail damage to their roof so they can get it replaced without having to spend their own money for it. They'd like to use their insurance policy to do this, but if you've got actual cash value coverage and not replacement cost coverage on that roof, you're going to get the replacement cost minus the depreciation. So let's say, a roof is expected to last, I'm making up numbers here, but let's say 30 years, that's a little long. And if your roof was 15 years old and you've got and you've got actual cash value coverage, it's going to pay you 50% because your roof is 50% depreciated if it's a 15-year, if you're 15 years into its 30-year lifespan. You pay a little bit extra, and if your house is in good shape, they'll give you replacement cost coverage. And that replacement cost coverage will pay for a brand new roof with no deduction for depreciation. And again, you've got to qualify for that coverage. It's not like you can just pay extra. It's not like you can go buy a house that's in horrible, disrepair and then go buy a replacement cost policy on it, hoping to God some windstorm is going to blow your house over so you can get replacement cost coverage on it. The agent and the company will not touch that. Now that we've got the ability to see the condition of the house pretty easily with a drone or some other satellite technology, this is really, they're very particular, they being the insurance company, are very particular about offering replacement cost coverage. And the same is true of your personal property. If you've got, if you pay extra, you can get replacement cost coverage for the cost to replace your stuff. But let me just back up for a moment. When we talk about replacement cost coverage, you have to actually replace it. It's not like you can say, hey, my roof needs to be fully replaced. I know what it'll cost. Here's the quote for it. Just write me a check. They're like, no, we're going to give you a check today, if you want a check today, for the actual cash value. And after you prove that you've actually replaced it, then we'll pay the difference. But an insurance company will not pay you the replacement cost unless you actually replace it. Same thing for your personal property. If your house burns down to the ground and you have replacement cost coverage, they will pay for you to actually replace your stuff if you've replaced it. But if you give them a list of everything that you own and some things you didn't replace, like this chair, and you're like, but it was priceless. Everything has a price. And so whatever that chair was, if you didn't replace it, and of course, if there's a total fire, it's very difficult to prove what you owned, but they attempt it, they'll give you the actual cash value, which I also like to call the Craigslist value of your used stuff, unless you actually replace it. When you think about comprehensive or collision coverage on your car, what kind of coverage do you think you have there? Do you think it's actual cash value or replacement cost? If your car is stolen, what are they going to pay you? If you've got a 1995 Toyota Camry and it gets stolen, what do you think? The actual cash value. So what the fair market value, what it would have sold for had you been able to sell it the day before the loss. That's right. But occasionally, if you've got just a dented bumper and you've got collision coverage, they'll put a brand new bumper on there and they're not going to haggle with you. But so that actual cash value versus replacement cost coverage valuation method, I think is pretty straightforward, but just calculating that depreciation can be confusing for some, but those are the valuation methods. Now, of course, most coverage comes with some kind of a deductible. And that's just your share of the loss. And insurance companies love deductibles. And one of the biggest reasons they love a deductible is because when you think about the administrative cost of settling a claim, you got to hire a human being usually. Maybe now we've got algorithms that can do this, but in general, there's a human that has to be hired. And whether the claim is for, a small amount or a large amount, maybe you're spending the same amount of time setting up the loss, doing all the administrative work in advance. You think about a health insurance claim and just all the administrative goo that goes on with trying to deal with that. When you have a deductible, you can eliminate so much administrative expense by just saying, look, if you're willing to take on the first $500 of every loss, or you just keep the small losses in your own pocket and we'll deal with the big ones, that insurance company is going to give you a big discount because almost all losses, they start on the small end, right? Almost every loss is going to involve some dollar amount. So if we can cut out the smaller losses, you've cut out a huge chunk of your administrative expense. So reducing costs for the insurance company to avoid small claims is one of the biggest benefits of a deductible. But also, of course, for those larger losses that blow through the deductible, it reduces the total payout because now the insured is bearing a part of that loss. And because the insured is bearing a part of that loss, then they're less likely to be guilty of moral or morale hazards. They're less likely to, if you've got a big deductible on your, car for comprehensive coverage, which would include like theft losses, you might be more inclined to lock the door. If you don't have any deductible, and be like, who cares? I'm insured. So that deductible can reduce the risk that people are going to be careless or unscrupulous when it comes to exposing their property to loss. Now, deductibles can come in a lot of flavors. A straight deductible, which is what most of us are familiar with, like a flat dollar amount. Although on homes right now, I have a 5% deductible on my house, which means whatever my coverage A or whatever the insurance amount is on the house itself, I have to pay the first 5% of losses and they'll pay the rest. So obviously that 5% changes every year. If my coverage goes up, my deductible goes up, and they're happy to, give me a discount sort of because of that. But a straight deductible is per loss. So if I have 10 claims in a year, I have to pay a deductible on each of those claims. But if I have one big fire loss, my whole house burns down to the ground. I lose my house, all my stuff. I've got, my garage maybe goes down with it. That's all covered under my homeowner's policy under one deductible because that was one loss event. And again, we're only talking about property coverage. When we get to liability coverage, there is no deductible for liability losses. The insurance company pays from $0. But for property coverage, there's almost always some deductible, some amount that the insured is going to pay. So moving beyond the straight deductible, there are two other unusual kinds of deductibles that you are unlikely to run into other than in this course, or unless you're a farmer and you're insuring your crops. Because both of these tend to be used in commercial situations. A franchise deductible versus a disappearing deductible. A franchise deductible is really crop hail. So I don't know how familiar you are with crop hail insurance, but if you're a farmer and you have a crop and it gets damaged by hail, you can buy insurance for that. And the way a franchise deductible works is you set a percentage usually. And the insurance company says, look, Mr. or Mrs. Farmer, if your loss is, less than 5% of the total value that we're insuring, it's on you. If it's more than that, we'll take care of the whole thing. No deductible for you. So this creates all sorts of conflicts where you might have a farmer now is incentivized to inflate their claim and say, hey, it was worth X, not Y, so you guys should cover the whole thing. Whereas a disappearing deductible is a deductible that gets a little bit smaller the bigger the loss is until it completely disappears. Once it achieves a certain size of loss, then you don't have anything out of pocket. The history on this eludes me. I don't know why you would ever have these types of deductibles. It just seems like it's a ripe opportunity to have a fight with your client. And that's the worst time to have a fight with your client is when you've got stress and, a claim going on. So those are in general the three types of deductibles, but by far, the straight deductible is the most common. All right, another issue that comes up when settling losses is this whole idea of co-insurance. This topic is so, I can't believe that it comes up as much as it does. It is very rare for you to have a co-insurance issue with the policies that you will run into. But where you're going to run into this is probably on the CFP exam. They love questions about co-insurance. Now, co-insurance is all about, smarty pants clients who realize that most people never experience a total loss. That the odds of my house burning down to the ground and sucking up every last dime of my coverage is really, really small. Hopefully I can make it my whole life without ever having a homeowner's claim, much less a total loss. And insurance is expensive. So if I'm clever, I'm like, why would I buy, $700,000 worth of insurance? I'm not going to have a total loss. Why don't I just buy 400, right? $400,000 worth of insurance should be fine. Now I have a mortgage, so my mortgage company is not going to be very happy about that. So, but if you didn't have a mortgage, you can buy whatever amount of coverage you want, except the insurance company is going to say, oh, that's fine, go for it. But we require you to carry at least X percent of the replacement cost in order to be fully insured. And so if you think you're so clever that you're only going to cover half the value of your house, then we're only going to pay the proportion of your claim that's equal to your amount of coverage you purchase versus the amount that we're going to require you to purchase. They don't require you to insure it to 100% of value, because think of all the issues that could come up. This year, it would cost you $600,000 to rebuild your house, but through no fault of your own, the coronavirus hits, and now everybody and their brother has contractors that, they've hired, and the cost to do any work has gone through the roof because of all sorts of supply chain issues. So now the actual cost to rebuild your house isn't 600, maybe it's 800,000. So insurance companies say, look, we're going to tell you how much we think it's going to cost you to rebuild your house. That they will do the math for you. So you should always let them do the math. And if they say, look, we think it's going to cost you $100,000 to rebuild your house, and we're going to require you to insure it for at least 80% of what we say if you want 100% coverage. And if you don't insure it for at least 80% or 80,000, then any loss you have, we're going to reduce the amount that we'll pay. So for example, in this situation where they say it would cost 100,000 to rebuild, and they're requiring me, because they know that, there's a little bit of conflict of interest there. What if they told me it was going to cost 600,000 to rebuild a $100,000 house? I'd be like, you're smoking crack. I'm going somewhere else. They're like, fine. You just insure it for 80% of what we say, or 80 grand, and we'll insure 100% of your future losses. But instead you buy $40,000 worth of coverage. You're like, I don't need 80, I only need 40. But they told you that they expected you to insure it for 80% of its value. You only insured it for 40,000, or half the amount they told you to. Therefore, that half the amount, you only chose half the amount they told you to, then all loss payments are going to reflect that percentage up to the maximum of the amount of coverage that you purchased. Does that make sense? Where it gets tricky is oftentimes what people will do is they'll say, well, if you only bought $40,000 worth of coverage, then that's 40% of the replacement cost. They think that means 40% is the claim payment. No. They told you how much to insure it for, 80%, or the dollar amount, 80,000. And that's where you need to do your math. The proportion is based off of the required insurance amount. That's where people get tripped up with coinsurance. You'll probably see in some future question some simple math like that to be done, where you have to figure out what the insurance company would pay you for a loss based on somebody who chooses not to insure it for 100%. All right, I'm pausing. So that's 11.2. Any questions or stories anybody wants to share about insurance claims? No? Okay. I will say this, just while we're on this topic, it'll probably come up again during our discussion on the homeowners policy, but from a client standpoint, most people will probably never have a big claim, but those that do, like especially involving their home, and I don't know if anybody who's listening or in the room has ever had a bad fire happen in their house. Anybody ever have a big house fire? if anybody online has and they want to tell a story, well, I apologize that the echo hasn't gone away. The hardest part for people that have a total fire loss, I mean, besides it being horrifyingly, sad that you've lost your stuff and it's inconveniencing, but trying to remember what you owned is crazy. They're like, I have no idea what the heck I owned. And you have to produce a list. And so as a, future person who might interact with clients and you're trying to help them prepare for losses, taking photos or videotapes of just like walking through their house and saving it to the cloud can make a world of difference. When I worked for State Farm as an auto claim rep, yep.
This is a little different story, but at my house, we had some sort of flood, asbestos or something. There's something wrong. And we got a lot back from insurance. And I just remember my parents said, like, there was Mentos in the garage where it happened and they got money back for something as little as that. So
right.
I thought that thinking about everything you own, something as little as Mentos got money back from insurance, but so it was really interesting.
I think it's a very instructive experience to have a homeowner's claim. The woman who trained me when I started my claims job a billion years ago, eventually moved on. She moved back to Minnesota with her family and had just built a brand new house and left a candle burning and burnt her house down to the ground. And they were in the house when it happened. And even somebody who's knowledgeable, obviously, about risks, because she worked for an insurance company and she was a smart person. She was not careless. It's just like one of these horrible things that happen. She did not have photos to go by and trying to, you've got PTSD when something like this happens. So anyways, I said all that to say, most of what you're going to take away from this chapter is probably going to be, you're going to be thinking about the personal side of things, maybe less so about the commercial, but a lot of this applies to both. Speaking of which, moving on to cyber property risks. I mentioned that this is an area that, we all have some experience in cyber crimes. And we're all likely, it's not a matter of if, but when you're going to have your identity stolen. If it hasn't happened yet, it's about to. I mean, we're all going to have something happen. And it doesn't list on here from a risk management standpoint, one of the easiest things that you can do is to freeze your credit record and to freeze your banking record. But those are things I want to make sure we talk about just briefly, because from a risk management standpoint, we're mostly focused here on the threats to commercial enterprises. But you could protect your own personal financial well-being with a lot of these things, between, I don't know about antivirus software. I think that it used to be a much bigger push, but right now it's mostly about, protecting your data and your passwords and encryption. And if you're going to be a financial advisor, you're going to be a huge target because hackers are going to assume that you have some access to people's financial records and they're in some ability to get into their accounts. So it'll be important for you as a, operator of a business yourselves, but also for you as somebody who's giving advice to others potentially, or for you as just an employee who understands that it is annoying when they require your password be changed every quarter or more often, or you're required to use a virtual private network so that, you protect their data. Anyhow. So let's do a quick review of the various causes of cyber risk, or at least the terms that go along with it. And these are the things that companies are really very careful to tell their employees to watch out for. Because when you run a company and you have an employee who's careless and they click on the wrong email, you've just invited somebody in. And that's what phishing generally is. An email that looks so good, and I'm sure you're able to spot them much better than most, but that phishing attempt to try to get you to log in and use the their fake site to steal your username and password. Or key logging, where somehow, software has been downloaded or at least loaded onto your computer, and now they're able to record everything that you're doing, your keystrokes, so that they can tell what your username and password is. Another cause would be, and this it doesn't come up as often, but it's called a denial of service attack, where essentially they jam your website if you're a company using bots or computers that are essentially now just going to flood your website with traffic and prevent it from operating properly. Or the thing I'm always telling my husband not to click on, because he's always almost clicking on something he shouldn't. And I'm like, please, God, don't click on that. I know it looks interesting, but do not click on that. So again, following a fake link from an actual website as opposed to an email. Cookie theft via web browser. There's, the other thing is just like shoulder surfing. That's not on here, but that could be something that'd be more common at work. And the various tools that are used to commit these types of crimes almost always involve some kind of malware, whether it's a computer virus that requires a human being to take action, to click on that link or to take the bait, whatever it is, versus a worm, which is like a virus, except for it doesn't need a human to interact. It just spreads by exploiting some weakness in your system. Versus a Trojan, which is something that looks legit, but then wreaks havoc. Again, it's tricking some unsuspecting user. Spyware, which isn't that, you guys are probably way too young to remember that the file sharing network that was infamous for downloading spyware onto your computer. Everybody and their brother was sharing music files before you could really get music as dirt cheap as you can now. But anyways, spyware using your information and sharing it without your permission, which is essentially what we're all subject to now via our existence on the internet. We are all being tracked constantly and resold. Malicious bots. So there are lots of legitimate bots in the universe, but botnets that are all connected and acting for malicious intent. So when they're talking about malicious bots, they're talking about networked bots. And ultimately, oh, bless me, trying to take over infected computers and essentially turning them into zombie computers. And then ransomware, which gets a lot of attention, where a company has their data being held hostage and the people that are holding it hostage will say, we'll give it back to you, just pay us. And of course, there are steps that can be taken to protect against that. But you have to deal with the threats, which might be internal threats from either contractors or employees. I think the book touched on this, that this is essentially what happened to Target when they got hacked. It wasn't an employee, but rather an HVAC contractor that the hackers stole the HVAC contractor's login information and were able to access Target's systems that way. And if you ever want to read a fascinating tale of a way to screw up, read what Target did during that. Like in advance of it, they had paid all kinds of money for this fancy software to protect themselves, and they just never implemented it. And they were warned by the company that was working for them to help protect them that there was some kind of intrusion, and they ignored it. So I just love these stories. I think they're fascinating tales, and I think they can be instructive. But anyways, so your biggest threat to your company and to you, really, for your personal stuff is you and your employees. Other cyber threats They refer to regulation, and this is sort of interesting because it's not about being robbed. It's about changes in things like how we collect income or collect sales tax. You know, for a long time, companies, and we still, I mean, when you buy something online, there's a pretty strong chance you're not going to have to pay sales tax on that thing if there's not a physical store in your state. Some will just automatically charge you anyways, and you're supposed to report it on your tax return if you did buy any products that you didn't pay sales tax on. But that would be considered a regulatory or legal change threat from a cyber standpoint. And then these last ones, this domain name hijacking or cyber squatting or website hijacking. Mostly it's, I like the example that was provided where some guy who apparently was not a big fan of the ethical treatment of animals bought the web domain PETA.org. And it was something about people for the eating of animals or something. It was like the opposite of what PETA stood for. And PETA sued. I don't remember what the end result was, but so that was considered cyber squatting. They all have different intents, but the bottom line is it's a threat that most companies face. You yourself, when you start a business and you're trying to, you know, find out the right domain name, the right business name, part of your evaluation for what you should use for your business name is going to be your ability to buy the domains that are consistent with whatever your business name is. Okay. So the risk management techniques associated with protecting yourself against cybercrime and cyber threats are not very exciting, as most aren't, right? It's doing system audits, using security software, antivirus protection, backing up your systems, you know, having procedures in place for protecting data. And this is, again, both on the personal side as well as, you know, if you're giving advice to a business or if you're running a business, your password policies, encrypting email and encryption software in general, having firewalls, using VPN, and then hiring people to come and hack your system so that you can see where you're vulnerable. There is some insurance that's available for these types of risks. You know, on the personal side, it's not really going to do you much good, right? Because what usually happens, like what's happening to my client, the cardiologist who had a bank account set up fraudulently in her name, she's just going to burn a lot of time and she's going to pay me to help her. And she has American Family Insurance on her house, and I think she might have some kind of identity theft coverage, but it's all going to fall underneath her deductible. It's just a pain, and it's very disconcerting, you know. And part of the problem with identity theft is monitoring requires you to be constantly on the lookout and know that some types of activities are going to be almost impossible to detect. One of the things that really blew my mind, I learned it as a result of what just happened to my client. You know, we had reviewed her credit report within the last year, just as a matter of doing reviews. So I'm just like, does anything look out of place or suspicious on this report? She's like, no, everything looks fine. I recognize all of those accounts. Well, one thing that doesn't end up on your credit report are checking accounts. So if somebody's opened up a checking account using your credentials, that doesn't show up on your credit report. And which is why you want to freeze your banking record as well as your credit record through all of the bureaus. So I don't know if I'm going to find it. Let's see if I can. There is a great link, an article on one of my favorite sources, Reddit, that gives you the steps to take if you are the victim of identity theft. And I give my clients this link all the time because what I really want them to do is this section to freeze your credit with Experian, Equifax, TransUnion, and Innovus, the big 3 credit agencies plus Innovus is a smaller one. You never know, every bank, every credit card, anybody that's interested in checking your credit record usually has a deal with just one of these, not all of them, right? So you have to freeze your credit record with all of them to prevent someone from being able to establish new lines of credit or to like apply for a bank loan or apply for a PPP loan using your social security number. And then you can place a freeze with checks systems, which is a clearinghouse for banking information, so that if it turns out, if you're bad at managing your bank account and you bounce checks all the time, the banks are gonna they're gonna chit chat about you and your banking record via check systems. They will tell on you essentially, so that their banker friends don't end up opening up an account for you. So freezing your check system record is not a sure thing, but it's smart to do. And if you haven't done that, I would absolutely recommend you do, as well as freezing your credit record. Not only will it protect you from somebody establishing new credit, it'll prevent you from like willy-nilly opening up credit cards that you probably don't need anyways. Because every time I go to a store and they're like, hey, would you like to open up? I'm like, nope, I can't, my credit's frozen. So those are I think, some of the best ways to try to prevent having your identity stolen, but nothing is a sure thing. Your social security number is floating out there in the universe. Mine sure is. And people can use it and file fraudulent tax returns. And you just have to be on your game and not freak when it does happen. From an insurance standpoint for commercial businesses, again, this is going to be it's going to be unique coverage. It is not going to be a standard policy. And it'll be limited, very limited coverage, because one of the biggest hits you're going to take, like what Target took hit-wise, is to their reputation. So your risk management is really going to be less about insurance and more about just not having it happen if you can avoid it. And also about the PR and managing the aftermath.